Well, as we point out there within us, Willix, higher wages, higher energy prices put pressure on inflation and therefore interest rates. And it seems this cycle will not be easily broken. So let's bring in here the ANZ Bank's chief economist, Richard Yetsenga. And Richard, your confidence numbers today, you say, have dropped to recessionary levels. What exactly do you mean by that?
Well, it's a factual statement. The last time we saw confidence this low, Australia was in recession. A bit different this time, well, a lot different actually. Last time was high unemployment, low job security, low incomes. This time the problem is the cost of living crisis. And you're seeing this kind of combination of pretty decent consumer spending but really low consumer confidence in New Zealand, in the US. It's a pretty prevalent issue because of what's happening to inflation.
OK, what's happening to inflation comes back to the wages we saw today, that decision. It comes back to energy prices, with people now frightened about the prices, about what people are seeing in the stores that prices are going. The question about inflation is whether it actually just flows through and within a year's time we all adjust and everything comes back to normal, or whether this is something that is sticky, that's hard for central banks to control.
Look, we might have some hope that it would flow through as a lump. Of course, you're still kind of permanently worse off from a real income perspective, but it might not be ongoing inflation if monetary policy was at the appropriate rate and if fiscal policy was appropriate. The reality is both have been very stimulatory for the economy the last 2 years. Policy is not at the right level to be confident that these one-off price changes are not going to feed into ongoing inflation. So we've got to get some tighter policy and we've got to get it lickety-split.
Well, you've got to get it lickety-split. Is the Reserve Bank behind the curve? Should have it started earlier?
I think the bank would say they should have started earlier. Some things have happened that have surprised all of us. A war in Europe, energy market problems here, but other countries have also had energy market problems and other countries also are behind the curve. The Fed, Reserve Bank of New Zealand, Bank of Canada, Bank of Korea. There's been a bit of, I think, collective groupthink from policymakers and now, we've got a bit of a pickle. Is
there a danger that the central bank, the Reserve Bank, goes too far and harms the economy simply as they're trying to quash the inflation?
There is that danger, unfortunately. I think one of the, old central bank playbook rules was don't get too far away from reality lest you have to try and catch up in a quick sequence of steps. And when you have to catch up quickly, calibrating exactly where you need to get to when becomes much more difficult. Unfortunately, that's the situation we're in. So the risks around the economic cycle have gone up.
And is the real risk here the employment number? Right now, when people have got jobs, they can manage, they can cope. It's when people start to lose jobs, that's when the real pressure will come on house prices, on the economy, on spending.
Look, our forecasts do now have the unemployment rate rising a bit. If we're front-loading more interest rate hikes into 2022, we should expect...
But right now, businesses can't get workers.
So a slightly higher unemployment rate, I think, probably will help everyone operate. The economy operate a bit more easily. There'll be some workers worse off, but I think for the broad thrust of the economy, it'll be operate just with a bit more evenness. It's getting it not to rise too much. That's the balancing act, right?
And very, very quickly, where's your peak in the central bank's interest rates now?
Oh, above 3% next year now, and not that far from 3% by the end of this year.